We're joined now by Christine Lagarde, former head of the IMF, now the president of the European Central Bank. Good morning. Good to
morning,
have you
Margaret.
here.
Lovely to be back.
And your recovery's going all right?
Yes, in a couple of days I think I'll be fine. Hope so.
I'm glad to hear that. You have a long list of things ahead of you, and I want to ask you about the global recovery. You were speaking a few days ago, and you said the recovery for the economy is fragile and uncertain. In this country, the Fed thinks we'll see a mild recession later this year. What is it that you predict?
First of all, there is recovery. That's, I think, a point that was not really firm only 6 months ago, where we all assumed that there would be a recession, if only a technical one. If you look at all the forecasts at the moment, it's all positive. It's been slightly downgraded. You know, the IMF went from 2.9 to 2.8, so it's a 0.1 revision downward, but it's positive. From a European point of view, we have also upgraded our numbers for 2023 at 1% and then 1.6 for the 2 next years.
In terms of growth?
In terms of growth. So we have growth. There might be here or there in my 20 member states a country that has a technical recession, which means 2 quarters negative in a row. But overall, we have a recovery, and we are faced with high uncertainty because of multiple factors. You know, from our corners of the world, it's the war in Ukraine, it's the financial stability that clearly has been shaken up a bit by the US and Switzerland developments. It's inflation that we are fighting. It's all that which really create a halo of uncertainty around a recovery that we want to embed. That's pretty much where we are.
So there were those recent bank failures here in the United States, also one in Switzerland. Given that, it sounds like you're saying you don't see a hard landing. You're seeing a positive trajectory for the global economy.
I think we have a narrow path to navigate, which requires that both the governments and the central banks around the world adopt the right policies. For us, it means fighting inflation, making sure that it returns to that 2% target medium term that we have.
You're about 8.5% right now in the Eurozone.
No,
right?
no. We are lower than that. And we project, 5.4 headline, 4.6 without energy and food. So it is declining. We're moving from, over 10% and a little over 5%. So it has declined significantly because of base effects. Energy was super expensive a year ago. It has gone down significantly. Now, of course, if we face another shock, if energy becomes extremely expensive again, that's
OPEC
another
just
story.
cut output. OPEC just cut output, but you don't see that as a disruption.
I know, and we have to be very attentive. But in the meantime, if you look at it, I have to look at Europe at the moment. We have reduced our overall consumption of gas energy, for instance, by more than 15%. So it's not as if we negotiated here or there. We just cut down our energy consumption, number one. Number two, we have renegotiated with multiple partners, ranging from Norway to the United States of America, which is a big supplier of our energy. And I think that our dependency, which we learn the hard way about, has significantly declined. So I think that we moved from the illusion of plenty of energy, free money, to a time of resilience and building buffers. This is what has happened.
It's interesting to hear that optimism. I mean, given the bank failures we just saw, you hear from bank CEOs in this country this idea that they're getting more cautious about lending money, largely, that there's some contraction in credit there. How concerned are you, and how does that complicate your planning?
It's funny you should ask complication, because in a way it facilitates my planning and it complicates the future as far as growth.
Because it slows down business activity, so you don't have to raise rates as much or as frequently.
We don't have to reduce. We'll see, because we need to really measure what will come out of these financial events that took place recently. What impact will it have? How will banks react? How will they assess risk, and how much credit will they lend? But if they don't lend too much credit, and if they manage their risk, it might reduce the work that we have to do to reduce inflation. Okay? But if they reduce too much credit, then it will weigh on growth excessively. So it's a fine balance to have between credit risk good management on the one hand, and on the other hand, financing the economy as is expected by the business community. The business community wants to invest at the moment. Some of them have big buffers and they can use those buffers. Others are going to need credit financing from the banking sector and the markets, both of them.
I want to ask you about the U.S., and it's not a political question, it's an economic one. But there are predictions that the U.S. could default in its national debt as soon as June, some say September. And we have a political standoff in this country, virtually no negotiation happening on how to resolve this. Does that undermine your confidence in the United States? And what message does that send to the world?
I have huge confidence in the United States. You know, ever since my year in this country, in this city, in 73, 74, I have had confidence in this country. And I just cannot believe that they would let such a major disaster happen of the United States defaulting on its debt. This is not possible. I cannot believe that it would happen. But if it did happen, it would have very, very negative impact, not just for this country, where confidence would be challenged, but around the world. Let's face it. This is the largest economy. It's a major leader in economic growth around the world. It cannot let that happen. I understand the politics. I've been in politics myself. But there is a time when the higher interest of a nation has to prevail. I'm sorry.
And you think that will happen?
I have huge trust in this country, yet again.
You're bringing a lot of optimism to a show where we don't have a lot of optimism,
Madam
Lagarde. No, I like it. It's interesting. It's a change. I want to ask you, though, about what you just said in terms of U.S. leadership. You look to the other side of the globe, and Xi Jinping has said he wants China to be the world's leading power by 2049. And Beijing is very interlinked into so many economies, particularly in Europe. Is the U.S. losing global influence?
There is clearly a competition between these large economies. The U.S. is the first economy in the world. China is clearly competing and is putting all forces in that competition. I think competition is healthy. It has to stimulate innovation, it has to stimulate productivity, but it's inevitable that these two large economies are facing each other. What I hope very much is that they can have a dialogue, because you know, all these relationships, whether it's trade, whether it's politics, whether it's economic development, whether it is financial stability, it's a two-way street. We cannot ignore each other, and trade should not be confrontational. It has to be careful. It has to identify the areas that are strategic for one country or the other, or all the others, but it shouldn't be confrontational. I'm on the same page as Henry Kissinger on that, or Kevin Rudd, the new Australian ambassador. Conflict is not unavoidable.
But there is, it seems, increased political pressure to choose between the United States and China in many ways in some of these political capitals. Is that even practical from an economic point of view?
It would lead to economic downside, the amount of which is uncertain. Is the global economy going to be affected by 1 or X%? There are multiple forecasts. All of them are negative. So the decoupling and the sort of bipolarization of the world would lead to less economic growth, less prosperity in the world, more poverty across the world. So I think that this is something that should be by all means avoided.
Madame Lagarde, it's always wonderful to have you here.
Thank you.
We'll be right back.